A company sold its product cheaper than the market expected, and its stock lost value that very week. What looks like a contradiction to classic economics is actually a textbook case of investor psychology. Today we're breaking down what's really going on through the lens of Take-Two and GTA 6. Early in the process, the reference point was $100. Prices spotted on some retailers' digital storefronts reinforced that expectation. What mattered wasn't whether the figure was accurate. It was that it had settled into consumers' minds as an anchor. In behavioral economics, this is called the reference price effect. Once $100 lodges itself in perception, every number announced afterward gets judged against that anchor. And indeed, that figure sparked serious backlash among players. That consumer backlash translated directly into investor risk. Take-Two's projected $8 to $8.2 billion in revenue for fiscal year 2027 rests on a single assumption: high unit sales volume. The possibility that the price would be perceived as unfair and dampen purchase intent got priced in as a variable threatening that assumption. The framework analysts used was demand elasticity. Even if one segment of the audience was price insensitive, the broader base was assumed to be price sensitive. So the $100 scenario, while representing higher revenue on paper, was viewed as a scenario carrying high volume loss risk. On June 24, 2026, Rockstar announced the Standard Edition at $79.99 and the Ultimate Edition at $99.99, coming in below the speculation. The $80 figure didn't emerge in a vacuum either. Nintendo had already broken the $70 psychological barrier with Mario Kart World's $80 price tag the year before, giving the industry a live test case for how much resistance a major franchise could absorb without denting demand. Analysts had done the math on both sides of that line. Bank of America estimated that at roughly 45 million copies sold in the first year, the gap between a $70 and an $80 price point alone represented close to $450 million in additional gross revenue. That's precisely why some investors treated $80, not $100, as the rational ceiling, high enough to capture meaningful upside, low enough to avoid triggering the volume loss scenario analysts had been pricing in for months. The stock rose more than 3% in pre-market trading right after the announcement, but gave back most of those gains over the following days, closing the week down roughly 3%. This came down to a clash between two different investor readings. One group welcomed the removal of the $100 risk, while another saw it as a missed margin opportunity. A classic sell the news reflex compounded the move. The $80 price point was really an attempt to manage two risks at once: preserving the perception of fairness on the consumer side, while extracting extra revenue from the price-insensitive segment through the Ultimate Edition. Bank of America liked the model enough to raise its price target to $368. Jefferies maintained a buy rating in the $290 to $360 range. Until the November launch, the market's focus won't be on the price itself anymore. It'll be on how faithfully that price translates into actual sales. And that test will determine where Take-Two's stock goes from here.